Good evening, everyone. Thank you for joining us tonight. This presentation is recorded and it will be sent to everyone via email. There is a question button on the webinar where you can put your questions in and we'll answer them as we go. I would also like to introduce Katheryn DeClerk from Howard Hanna Rand Realty. She's going to be presenting tonight also. And I look forward to speaking to all of you when it's over. And the webinar is First Time Home Buyers, The Journey to Home Ownership. Next slide. Oop. There we go. So we're first going to start out with the path to home ownership, and we're going to explain how much you can afford, your credit score and your credit report, the application criteria, the types of mortgages, the components of a mortgage loan, homebuyer programs, and then the most exciting part, searching for a home. Next slide. Buying your first home. Buying your first home is one of the most exciting purchases of your lifetime. It is also one of the most financially important decisions you will make. Take the time to review the process and make the most financially sound decisions for you and your family. Next slide. Okay. Calculating what you can afford. We take into account various costs associated with home buying. You have your down payment, you have your closing costs, post-purchase funds, property taxes, and extras. So the down payment can vary. It could be 3% down, or if you can afford more, it could be 10, 20, whatever you can afford. Then the closing costs are based on the loan amount. And also when you buy a house, you have to pay the property taxes back to the seller for the taxes that the seller paid that you'll own the house. And if you're going to have an escrow account, you also have to pay enough to fund your escrow account. So in most of the counties in New York State, that is a full year of property taxes. Your post-purchase funds could be your moving costs, or if you want things done around the house, painting or items like that. And that could also go towards your extras. And the next slide. Credit in the home buying process. You should certainly access your credit report 60 days before you're going to apply for a pre-approval. You should review your credit report with all 3 credit reporting agencies, which is Equifax, Experian, and TransUnion. You should check each of them for the accuracy and if there's any fraud on your account. Now, if you Google annualcreditreport.com, there's going to be multiple credit reporting sites that come up. So you need to put in https://www.annualcreditreport.com. That is the site the federal government had the credit reporting agencies set up after the crash of the housing market, so individuals can review their credit reports for free. It doesn't go as a hit against your credit. Don't buy your credit score because it means nothing, because there's a different model for scoring your credit depending on what type of loan you're getting. So if you applied for a mortgage and 30 minutes later you applied for a car loan, those scores are going to be different because there's different models for scoring your credit. Next slide. Credit and home buying. Lenders rely on scores to determine the risk in lending money to you. The higher your score, the lower the risk. Most lenders use the middle score of the 3 bureaus. So say you have a 750, a 700, and a 650, we would go by the 700. Usually there's not that big of a difference unless there's something on one of those credit reporting agencies that's not on the other 3. But otherwise, the scores are typically somewhat close. Next slide. What makes up your credit score? So 30% is the amount owed, 35% is your payment history, 15% is the length of your credit history, 10% is new credit, and another 10% is the mix of the type of credit you have. So you want to have an installment loan, and you want to have revolving credit, and you want to have if you have a mortgage, that also brings up your credit score. So having a mix is good. When you get new credit, that brings your score down. Also, if you close old accounts, that brings your score down. So you really want to try to keep those older accounts open. Even if you pay it off, don't close it, because it does have a negative impact on your score. Next slide. So improving your credit. You want to pay down your debt, pay everything on time, avoid balance transfers to new cards. As I said before, keep old accounts open, and review your credit report annually. That's very important, and you can do that on annualcreditreport.com. And thank you. Applying for a mortgage. The following are considered when reviewing your mortgage application: your credit score, your down payment, employment history, and the income that you make from your employer, and your debt. These are all important factors, and they're all weighed pretty much equally. Next slide. So applying for a pre-approval for a mortgage. You definitely want to check your credit before you apply for the pre-approval. When you get a pre-approval, it's typically good for 60 to 90 days. There's we do not charge anything for doing a pre-approval, and it's based, on your income and your debts. Now, when I do a pre-approval, I always ask for your most recent pay stub and your last 2 years of W-2s, because that gives realtors more assurance in the fact that you really are approved for the amount that I'm putting on your pre-approval letter. Next slide. Okay. The mortgage process. We have the application. Once you find a house, we complete the application. You cannot lock into an interest rate. So when we do the pre-approval, your rate does not get locked in. It doesn't get locked in until you actually find a house and we're able to submit the completed application. And that's when you get what your interest rate is, the APR, and all the fees that are associated with the mortgage. Depending on how long ago your pre-approval was done, your credit may have to be pulled again. Once your loan is submitted for application, it goes to a processor who gathers the appraisal and the fully executed contract, and your loan goes into underwriting. The underwriter will review all of your documents. When they review them, they sometimes, in the review process, decide they need a little more information. Maybe an explanation for an increase in income or a large deposit. It really depends on the documents. So once you get your mortgage approval, it could be conditional with those items that the underwriter is looking for. Once you provide those documents, then your file is clear to close, and it goes to the closing department, and the closing department then reaches out to our attorney, who reaches out to your attorney and the seller's attorney to schedule the closing. Next slide. Okay. Types of mortgages. We have fixed rate mortgages, we have adjustable rate mortgages, we have VA mortgages, FHA, and SONYMA. First we're going to talk about the components. Next slide, sorry. the components of a mortgage. You have your principal, which is the amount that you borrow, the interest, which is the amount of interest that you pay on top of the principal for borrowing the money, the property taxes, which are the taxes paid on the house, and your homeowner's insurance. So typically you contact whoever you have your car insurance with, and you tell them you're buying a house and you need homeowner's insurance, and you get your homeowner's insurance policy from them. We will give you an estimate for an amount, but that amount is determined by your insurance company and the amount of coverage that you request. And finally is mortgage insurance. And you have to pay mortgage insurance on a loan if you don't put 20%, on a conventional loan if you don't put 20% down. On an FHA loan, you have to pay PM mortgage insurance even if you put 20% down. They require it for a period of time. Next slide. So Homebuyer Programs, we have the SONYMA loan, which also offers a down payment assistance loan, the Homebuyers Dream program, which is a grant, and we have the Fannie Mae Home Ready, the SONYMA Neighborhood Revitalization Program, Fannie Mae 3% down, and our own first-time homebuyer loan, which is called our Helper Loan. Next slide. The SONYMA loan is a loan provided by the State of New York Mortgage Agency. It's for first-time homebuyers, typically. And they do offer a 3% towards the down payment, but you do not get it until at the closing. So when you apply for the loan, you can decide if you need that extra 3%. So the 3% really helps you towards the closing costs. So they do increase the interest rate on the SONYMA loan if you need the down payment assistance. So for example, if the rate that you qualify for with them is 3%, the rate would go up to 3.375. And then at the closing, they would give you the 3% of the purchase price towards the transaction. That amount is forgiven after 10 years. So if you sell the house in 5 years, you would have to pay a percentage of that money back. Each year, 1/10 of that amount comes off. So if it was 5 years, you would have to pay half of that back. The SONYMA loan does have income qualifications, and they vary by county. And SONYMA has 2 loans. They have their Achieving the Dream loan and their low interest rate loan. And the SONYMA loan itself is for first-time home buyers. Now, one of the benefits of the SONYMA loan, especially in this market, is that it's a very competitive market, and a lot of times the seller is not going to give you a seller's contribution. So in getting the down payment assistance, it helps you, it gives you more funds for the transaction instead of having to increase the purchase price to cover money that you need towards the transaction. Do you have anything to say about that, Katheryn?
Yes, you're dead on right. It's a very hot market. So a seller's concession is not attractive to the seller. Seller's concessions mean the seller's contributing something toward the closing costs, and the purchase price is bumped up to account for that, which also raises a concern about the property appraising. And right now, in a lot of our markets, we're seeing multiple offers. There may be 6, 8, 10, 15 offers. So if that's the case, having something like a seller's contribution might mean that the seller doesn't consider that offer. I think the down payment assistance program is fantastic if it can eliminate the need for that concession. The seller doesn't even need to know about it. It's sort of a back office-y kind of thing. It doesn't affect the transaction. I kind of chuckle about the interest rates being, they're so low. And if you had to take a little bump in interest rate and you were at 3.3, I mean, I don't know if we're ever going to see rates staying at this kind of level. I think we have to keep sort of that in focus that, you know, going up a little bit on the interest rate, it's still a very low interest rate if we look at over time and where interest rates have been on housing historically. So if that can get you into a home, definitely consider that, because the closing costs are a big chunk, and a lot of times buyers don't anticipate that properly. And as Denise said, a big chunk of that is reimbursing the seller for the taxes that they paid for the year, as well as putting money into escrow. And if we're looking at a house maybe that's, you know, 200 or 250,000 and it has $6,000 worth of taxes, that's $6,000 of closing costs right there that goes toward that. So this is a great tool. I speak about it often with my buyers so that they don't have to do a seller's contribution.
Thank you. Next slide. So the Homebuyer Dream Program, it's a grant that's offered by the First Home Loan Bank. The first amount is going to become available in May, on the first business day of May. It can be combined with the down payment assistance. You have to be a first-time home buyer. You have to take the first-time home buyer course. You could actually take Fannie Mae's first-time home buyer class online. It's $75, I believe. To apply for the grant, you have to have a fully executed contract. We also have to provide the appraisal. So you have to have an accepted offer in place. And the funds become available on a first come, first served basis. And like SONYMA, there is an income limit, and it does vary by county also. And you must be, again, a first time home buyer. So the one thing that I tell people about this program, kind of think about it like hitting lotto. You have to be able to do the transaction without this money, because it's not a guarantee, but it's a bonus. So if we can get you that money, it's more money that you can use towards your transaction to bring your loan amount down and maybe make the house a little more affordable for you. Next slide. Fannie Mae Home Ready. This is a program that Fannie Mae offers for first-time home buyers. The borrower does not have to, sorry, it's not a first-time home buyer loan, sorry. It's a 3% down loan. You cannot currently own a house to do this program. And the borrower does not have to qualify on their own. They can have a non-occupying co-borrower, but you have to put 5% down. And there are actually lower income limits for this program than there are for the SONYMA loan. Next slide. So the Fannie Mae 3% down program. This program allows for a 3% down payment also, but there is no income restrictions with this one, but the one borrower has to be a first-time home buyer. Next slide. So our own helper loan. This loan also requires 3% down. There are income limits, which are higher than the Homebuyer's Dream and SONYMA. And they do vary by county. We offer this loan in the counties that we have our membership in, which would be Westchester, Rockland, Putnam, Dutchess, Orange, Sullivan, Rockland, and Ulster County. And it has to be a single family home, so we do not offer it on condos or multifamily houses. And the borrower does have to be a first-time home buyer. Next slide. This is where I turn it over to Katheryn.
This is where the fun starts.
That's right.
So finding a home. There's steps that we have to go through. We're going to talk first about real estate agents. Do you need one? How do you select one? Shopping around, deciding what you want in a home. The things that are included in the purchase doesn't include the washer dryer, things like that. Contingencies, and then actually making an offer. Next slide, please. One of the most important things, though, you can do before you even get started is get your pre-approval straightened out before you start. Agents will not take you out without it. There's a whole host of reasons. One, there's a duty to sellers to make sure people are pre-approved. With COVID, we also are trying to limit the interactions that people are having with one another. So making sure that someone is ready, willing, and able to move forward before they go into somebody's home and, risk exposing them during a pandemic. I don't think that's going to change and go back to more lax rules in regards to that. I think from this point on, everybody's gotten pretty used to making sure they have their pre-approval in hand. Why do you need it up front before you start looking? To make sure you're looking at the right homes and to make sure that you're comfortable in the price range that you're in. Going online and figuring out, how much can I afford to spend on a home isn't really the way to do it. What Denise does is invaluable because she makes sure you're going to be comfortable with the monthly payment that you're going to have. We all understand, rent. If we're renters, we know how much that is of our monthly budget. So making sure you're comfortable and it fits into your life. If you want a new car every couple of years, you go on vacations, things like that, making sure the price is right. There's nothing more heartbreaking than taking someone out and finding out they don't qualify in the price range that they're looking, and then they have to cut back. They seem to never recover from that experience. So sometimes we hear bad news, it may not be what you think, or there may be some issues, say in your credit, that need to be resolved before you're able to go forward. And that's where the value with the lender really comes. I've worked with Denise a long time, and sometimes I'll end up with a buyer who has a pre-approval from another company, and I don't know them. I don't know that everything has been checked. And I will ask them to speak to Denise, and then we find out if there are issues or not, because the last thing you want to do is start spending money and going through this process and finding out you can't go forward and you've already made expenses that you're not going to get back. So spending the time getting this piece done first is so critical before you even contact your real estate agent. They're going to ask you to go through this process if you haven't already. So do as Denise said, check your credit first and make sure you have this all laid out before you get started. The other problem with not doing it first is houses are going like this. I literally am working with a buyer who said that house has multiple offers and they're deciding highest and best today. She said, when did it come on? I said, the 28th. I mean, that was like 2 days ago. So this is how quickly things are moving. So if you don't have your pre-approval in place, you're not going to be able to secure a property until you have that. Now, when you decide on a real estate agent, we're critical to the transaction. We're the people who are there with you from the very beginning all the way to the end. And just like the lender is, but Denise gets to miss out on the fun parts where we actually go look at properties. So the real estate agent is free to the buyer. The seller pays the commission in like 99.9% of the cases. It's built into the price that they're charging for the house. And so it's not like you're going to be writing a check to your real estate agent. You want to be sure that you also work with an agent who has the time to dedicate to you, that's used to working with first-time home buyers, because you guys are going to have probably more questions than someone who's done this before. So make sure you select the realtor who is right for you. The slide mentions that they will be well-versed in the areas that they're searching. I guess that should say, make sure they're well-versed in the areas that you're searching. You might start looking for properties, maybe you're in Westchester and now all of a sudden you're in Rockland and then you're in Orange. You definitely want an agent that knows that territory, because you need some guidance on more than just, opening the door and looking at the house. So ask them what areas they know and work in and are comfortable in. Not every agent covers, multiple counties or even multiple towns within the county and different types of properties. You might be looking at condos, you may be looking at single family, so you want to be sure that the agent is well versed in all of that, as also that they have the time. Because with things selling in 2 days, if they're juggling too many buyers, you might miss the house. So a good question to ask them is, how many active buyers are they working with, and will they have the time to spend with you? Next slide, please. So finding a home, the shopping around, this is the fun part. Sometimes it's the frustrating part as well. You might have, dreams about what you want in the home. And so you may have to manage that with a partner, spouses that you have, and include that in. Make sure all the decision makers are there. That's another important piece. Make sure all the decision makers can make it to the property. Once you know what you can afford, then you can start looking for the home that meets your needs. There are lots of places to find listings online, and a good agent would be able to send you the listings as soon as they hit the market. Most agents are members of the multiple listing service, and there's a feature in it where it can email you a new listing as soon as it comes on, literally before it appears on any other website. Another good question as you're interviewing agents to make sure they utilize a system like that so you don't miss out. But there's a number of different, you might use the brokerage's site or some other third parties like realtor.com or something like that to search as well. But the best thing you can get is a live link into the MLS as soon as they come on. Next slide, please. Deciding what you want. Sometimes our budget doesn't match the things that we want, and you might have to make some sacrifices. A lot of times we do that with our first-time home buyers. You might want to make a list of all the things that are important to you. If you have a spouse or significant other, they may also want to do the same, and I almost suggest doing it independently. See what everybody's priorities are. Some people are more interested in the kitchen. Some people are more interested in the garage. So know what's important because you may have to do some trade-offs. If you are interested in school district information, there's a lot of sources for that online. Decide what school districts you're looking at or what towns are important. Maybe it's based on you have a commute to some place. Maybe you need a school district that has certain features. For your family, you need to know where those school districts are. Your real estate agent can't steer you toward any community, any town or school district. Their responsibility to you is to show you the homes in the price range that you want to look in those locations that you give them. Sometimes people will say, well, what's the best school district? I always say if I put 10 people in a room with copies of the school reports, I'd probably get a half a dozen different answers. It depends on what's important to you. It's very important that we comply with federal and state fair housing laws, and we don't have any say on what is appropriate for you. You make that decision, what neighborhood is right for you and your family. So narrow it down to a couple of locations. And I would also say visit those communities if you've never been there. If you're moving, say, out of the city and you're coming up to Orange County, spend some time in the community, get to know the area, visit the schools if they're open and you can do that, and just sort of get a feel for the communities. Sometimes you need a community that's got highway access so you can drive to work. Maybe you need to be close to a train. So depending on what your needs are, visit those areas and see which one feels right to you. Then within the individual house, often it's the number of bedrooms and bathrooms that people are thinking about and doesn't include a garage or a basement. So those are some of the things you'd want to tell your agent are priorities, but also be flexible. Oftentimes you might think you want a 4-bedroom, but you're really okay with a 3, and you may find a house that's perfect that has, maybe a finished basement or something else. So be flexible, be willing to make some trade-offs. And right now, because it is such a hot market, it's not like there's a lot of inventory to look at, especially in a first-time home buyer price range. And say, for example, with the median home in Orange County being somewhere in maybe like the 370s, if you're looking for something in the 250, they go very fast. And you're not going to have the option of like going through 50 of them. So you take a look at all of them and see what kind will fit your needs, and if you can make some trade-offs. Stay flexible. Next slide, please. Contingencies. These are conditions that have to be met, and contingencies are options for you to get out of the transaction. So for example, you make an offer on a property, it's going to be contingent upon a home inspection. It'll be contingent upon financing, you getting your mortgage. That would also have a contingency, typically for the appraisal, if the property doesn't appraise for the price that you're buying it for. If you have a previous home that you need to sell, that could be a contingency, and the mortgage is your financing contingency. So these contingencies are little benchmarks along the way in the process. We do purchase offers here in the Hudson Valley, and by Hudson Valley I mean really anything below Dutchess, Ulster, downward, New York City, Long Island, and then the attorneys draw up the actual contract. So we take a purchase offer. It doesn't take any money with that. And then the next step, if your offer is accepted, you start spending money on your home inspection. So make sure you want that home before you start your inspection process. This is where you're going to get to see the condition of the home with a licensed home inspector, so you know exactly what it is that you're purchasing. And no home's perfect, by the way. They always find something. That's their job. And you expect to find something that's very, very common. When you find a home, the next thing you're going to do is make an offer. So go ahead, next slide, please. And the offer has at least 3 components. It will have the purchase price, how much you're offering, the closing date, when you expect to close. It also has in it how much you're going to be putting down on it, how much money, if it's 3%, 5%, 10%, 20%. It will be all detailed out, how much will be held in escrow, and how much in total will be included. This is also where, if you do need a seller's contribution, we would disclose that in the offer. A typical closing time, right now, I would say from the point of an offer till you're handed the keys, you'd be really lucky if you could get in 60 days. Everything has been moving much slower than it had for years. A lot of that due to the sheer volume of transactions being done, which affects lenders, title companies. You need municipals. There's a lot that goes on sort of behind the scenes there. So I would say you're probably looking at not really 60 days, probably more like 75 days. And depending on how many conditions your loan comes back with and extra documents you have to provide, it could even be 90 days. But generally not less than 60. And so that's also what sellers are anticipating, typically 60. The only people who can really close faster than that would be if it was all cash and they didn't need a mortgage. How long is the offer good for? I don't find that there are expiration times on offers. Some markets do that. It could happen, but it's not happening really very often. You might make an offer on a property on a Friday when showings start, and because there's so many showings, and I mean 30 or 40 showings in 3 days, nonstop, back-to-back showings, multiple offers. They may ask for all offers, will be looked at on Monday. That's not at all unusual. And I guess one thing to mention is always to look at it that you're not competing with the seller for the home. You're competing with other buyers. So you have to make the best presentation to the seller and get them to pick you. Patience can win out in a lot of cases, and offering other kinds of terms that could be attractive. The closing date, if the seller would like a little more time and you offer that, hey, if they need an extra 30 days, and you're in a rental and you can do it, that might mean the difference between you getting the house or someone else. So, talk with your agent about other terms that could sort of sweeten the pot for the seller. Depends on where they're going. If they don't have a place yet, extra time could be helpful for them. So don't just consider price as being the only thing that may be important to the seller. It's one of several. Next slide, please. Once your offer is accepted, then the next step is a home inspection, again, with a licensed home inspector. They're going to look over the house and check everything. Depending on the kind of loan that you choose, there may be some condition requirements that need to be there for you to get that loan. If you go FHA or VA, the loan does have some condition requirements, and the things that come to my mind, no peeling paint, for example. And there are other things, but going with a conventional loan or the SONYMA, they don't have those issues. So those might be the kinds of things that you can tackle later after you close. Repainting could be something that you could do. So trying to consider the different kind of loan based on the type of house that you're looking at. So the home inspection, that home inspector will look at all the systems, the heating system, electric, plumbing. Oftentimes they do check some of the appliances, but they're not typically running the washer or dryer or something like that. They look for cracks in the foundation, asbestos. They can test for radon. If the house has a well and septic, they'll test the well, and sometimes you might want a separate septic inspection. So if the house is agreeable to you and there's no surprises you weren't counting on, then the next step is going into contract. The attorney draws up the contract, you sign, you put down your deposit, and then the seller will sign. Once those contracts are fully executed, then it goes off to the bank and you start finalizing your loan. As Denise said, it'll go to the processor. You start getting all your documents together. At the same time, there's other things happening. Your attorney may order a survey to be done. The title work will be done as well. When you get closer to the closing, you've got to finalize your homeowner's insurance. And like Denise said, start with whoever you have your auto insurance with. That might be a good place to start, or your real estate agent can recommend some people as well. The last thing just before closing is the final walkthrough, making sure the house was as you saw it when you did your home inspection and that nothing has happened and everything's the way that it was. That often is done the morning of, the day before, once the seller's gotten out, so that we can see that there's no damage, say when they're in the course of them moving out, and then you go to the closing. Used to be, we would all be there at the closing, but with COVID, they've limited some of us. So sometimes your agent's not there. We don't really have a role to play other than to chat with you. And truthfully, you're busy. The attorneys want you paying attention to them as you sign all your documents. There's the note, the mortgage, and a whole lot of other disclosures and documents that you need to sign at the closing. When it's all done, you're given the keys, and you can head back typically right then and there to your new home. It's one of the most exciting things. I love working with first-time home buyers because oftentimes it tends to also be people at a stage in life. I've seen, young families who years later, they move to another home, or work takes them to another location. They moved in, there was 2 of them. I sell the house, there's now 5 of them. And, it's always like they're like part of the family. Being part of a first time home purchase is really an extraordinary time for people. It's not always the same with people who, move a lot for their jobs. So sometimes you have people who transfer and they move every couple of years. They don't always get as attached to the home as you do with your first one. And I think that's always very memorable. I can think about, my first home and every stage of that. So enjoy the time. They say it's a stressful time. Pick the right agent who can help manage that process for you so it's less stressful. And also think about the team that they put together, that they work well with the lender, that they have the recommendations for attorneys, home inspectors. It will really help you if there's someone there that can coordinate those other things. But the bank is so important to get it as seamless. And working with a bank like Mid-Hudson Valley Federal Credit Union, I mean, they're my choice. I often refer to Denise because I know that she's going to be able to do the loan because she checks everything thoroughly. I've been practicing 22 years, and when I'm the listing agent, sometimes I see pre-approvals and I don't know from the letters if everything has been checked. And as a listing agent, and you have to keep this in mind, you might be thinking, well, what do I care about the seller and the listing agent? You want them to recognize the bank. You want them to recognize the loan officer. So when they're selecting between all of these offers, they do consider which bank you use. And so that could be to your advantage to work with a local credit union. So that's, I think that's the end of my slides.
Yeah.
I think
Yeah.
a couple up after that.
Yeah.
So if you want to just go to
We
the
do.
next slide. And if you have any questions, please put those in the chat. I don't see any.
Yes. So the credit union partners with Balance. It's a financial consulting company. And if you remember that a lot of their services are for free, and this slide shows you their contact information. They can help you with, going over things on your credit report, or, setting up a budget. They can help you with a lot of different things. So if you need them, you can certainly go online and look up what they offer or give them a call. And the next slide. You can download a copy of our ebook, Your Journey to Homeownership, and you could visit www.mhbfcu.com/learn/ebook-library. Now, I don't know if any of you have any questions. And as Katheryn said, she's been in the business for 22 years. There's her information. She is a great real estate agent. I've been doing mortgages for over 28, so I have Katheryn beat by a little bit. But it's really important to get a pre-approval and to feel comfortable with what your monthly mortgage payment is. Right now, if you're paying rent, and say your rent is $1,000 a month, but you think you can afford a mortgage of $2,000 a month, you should make sure you're putting away at least $1,000 a month into a savings account every month and not touching it, because that's how you'll know if you can really afford that $2,000 a month. That's, some advice that I give to first-time home buyers a lot, and I think it's really important, because not only do you have your mortgage payment, but when you own a house, you also have repairs that could come up. You have to pay for heating oil, the electric, the cable. Some people are fortunate enough when they rent that those items are included in their rent. If you buy a house that has municipal water and sewer, you have a water and sewer bill also. And, depending on where the house is that you buy, you could have garbage pickup that you have to pay for. So there are, additional costs that come with owning a house. So are there any questions, Katheryn, do you see?
No, I don't see any questions, but I had a question. In fact, I was going to say, I've heard you say many times that about take the amount you're paying now, put the difference into a savings account and get used to it and see how
Right.
you function. Oftentimes people get pre-approved for a certain number, but they really don't try it out. I think they are the most at risk for not being able to live within that budget. And there are things that you're going to want to do, to buy, improvements you're going to want to make to your home. We don't always think about the extra things that we need. All of a sudden now you need a lawnmower, you need a snow
Right.
blower. So leave yourself a cushion, and you'll be much more comfortable in case anything were to go wrong or you're out of work for a little while. Always plan for a cushion, so you're comfortable. Those those monthly payments need to be made no matter what, and it's
True.
a wonderful way to create wealth. I mean, most wealth in this country has historically been made on real estate. So right now you're paying someone else's mortgage and you could be paying your own. And so not only do you pay down the debt that you owe on the house is also appreciating. Now, do they always appreciate? No, we had a downturn in the market, but historically over time, real estate does appreciate. And we're in a cycle right now of growth for whatever period of time that's going to be. So if you buy a $200,000 house and it appreciates 5%, that's $10,000, that you have made just by owning that asset. It's giving you shelter, you're paying it off, and it's also appreciating. So consider that. There are tax benefits to homeownership as well, being able to write off, your interest, your property taxes. So additional reasons why homeownership may be a better bet for most people than renting and paying someone else's mortgage. So.
Very true. Another important thing for once you find a house and you have your mortgage application in process, make sure you pay all your bills on time, because before you close, your credit has to get updated and they look to make sure that you don't have any new accounts since you first applied and that your balances are the same and that you have made all your payments on time. So that's really important. Also, try to stay at the same job because they do verify your employment right before you close. If it happens during the mortgage process that you get a better job offer to go work somewhere else, I mean, that's okay. You just have to provide the documentation, but it could slow down the process. So those are, my suggestions and my advice. And if you have any questions.
So I have some questions here that I'll read to you guys. Our first question is, what is an escrow account?
An escrow account is part of your mortgage payment. So if you don't put 20% down, you have to have an escrow account. And it is your taxes, your homeowner's insurance, and the mortgage insurance. And every month you pay 1/12 of the yearly amount in your mortgage payment.
It's sort of like a forced savings account to pay the bill when it comes.
True.
And if you sell the home, the money that's in the escrow is your money when you sell, so you do get that back, and someone's going to reimburse you for the taxes you prepaid the same way that you reimburse the seller. And just to add to what Denise said about paying your bills on time, don't take on any additional debt either. It's not the time to buy a car. Don't think because Huffman Proof says there's no payments until the year 2023 that hits your credit. So those kinds of things are not a good idea beforehand. And when in doubt, talk to the lender and ask them, if you wanted to do something, or, like Denise mentioned, there may be questions about, say, large deposits into your account. If you're getting a gift or something, be sure to talk to the lender, because just making those decisions might mess things up. Do you want to add something on that, Denise? Because
so gifts can only come from family members and a direct family member. So mother, father, brother, sister, aunt, uncle. And it cannot be cash. It has to be documented. So you want to get a certified check from them. If you get a personal check from them, you need to get a copy of their bank statement showing that they had that money in their account when they gave you that check.
Okay. I found that for some of my buyers who didn't have a large down payment, they were also borrowing from their 401k to make, or their IRA to make a deposit down on the house. So again, talk to the lender about what kind of funds that you're going to need and if those things, you know, make sense.
Yes, you can borrow from your 401k, and that debt is not counted against you in your debt to income when you're buying the house, since it's your own money. Even if you borrow it and you have a payment plan set up, we just look to see the terms and conditions of the withdrawal, but we still do not hit you with that monthly debt.
Okay, I have a bunch of questions here, so I'm just going to start reading through those. If you buy a house in August or any other time of the year, are you still required to put down the entire year of taxes?
So it's not that you put down an entire year of taxes. So if you buy in August, September your taxes are due, your school taxes. So that means the bank has to take at the closing enough money. Actually, it's the title company that takes it because they make the payment. They take enough money to pay that school tax bill when it comes due in September. Plus your September, so if you close in August, you have September, October, November, December, you have 4 months, and then your property taxes are due. So they have to take almost a full month of property taxes to have your escrow account set up to make the payment when that payment comes due.
No matter when you close, you're going to be reimbursing the seller and you're going to be putting money into escrow. So
Correct.
sometimes it's, you know, you're closing in January and you just have town and county taxes due, but either way, then you still have to reimburse the seller. So it's a full year's. I always say the thing about the taxes is that you're going to be paying that anyway. And when you sell, you're getting that back also. So it's
Right.
not like something you kind of bought, and I don't want to say that there's anything here you bought and you don't have something to show for it. You bought a home inspection or, a survey, but in this case, you're putting the money up front and then it's, you do get that back when you leave. So look at it that way, but you do have to show up at the closing able to basically pay a year's worth of taxes up front. Just goes into different places.
Okay, so our next question, what are income qualifications for the SONYMA DPAL in Ulster County?
So the SONYMA loan, it varies. As long as you qualify for the SONYMA loan, you can get the down payment assistance. If they send me an email, only because I'm on my iPad, so I don't have the SONYMA income limits up. If you can skip to the next question and I'll look it up real quick.
Okay, and I have her contact information too, I can share with you. Angelina, if you want to just indicate in the question or chat box with your email, phone number, we can reach out to you directly. The next question, what are some tips for first-time home buyers in the current fast-moving, highly competitive market?
That's all you, Katheryn.
Well, I guess the first thing is be flexible with your schedule. I had this conversation with a buyer this morning. They're corrections officers. They work 3 to 11. And I said, so if something comes on, we can't wait until your day off. You've got to get up here as soon as it comes on. So we need to go see that house at, say, 10:30 in the morning so you can get to work in the afternoon. They work at Rikers Island and as corrections officers. So be flexible and be willing to, at the drop of a hat, go see a house when it comes on. Also, make sure you select an agent who can offer you some virtual services. If you don't live in the area and you can't get there for some reason, can they go and virtually show you the house? literally FaceTime or WhatsApp you so you can see it with them. The expect to pay at least asking price. There really is generally no negotiating. When, again, you're not competing with the seller for the home, you're competing with other buyers. If you hear that there are multiple offers, you can't start below asking price, and it's likely that it could go above. You know, a good buyer's agent can represent you and have their fiduciary duties to you, which means they can do a market analysis and tell you what homes like this have sold for in the past and give some guidance. As much as we try, we're also trying to predict the unpredictable. We don't know how much the next guy really wants this house. You get asked for things like highest and best, and that always seems like so confusing, because it's like, well, how do I know what it's going to take to get it? You don't. You know the amount that you're comfortable willing to pay. I say to buyers before they make an offer, know the most you'd be willing to pay and feel good about it. If we see a house and it's $240,000 and you say, you know, I'd pay $250,000, $255,000, I could still be happy. If you said, I wouldn't pay $260,000 for this, and you don't get it at $255,000, but someone else was willing to pay $260,000, then you should be okay, because you weren't willing to pay that. So offering to your comfort point is what's important, but recognize where the market is, and that you'll have to respond very quickly. You're not going to have a lot of time to think about it, and use the data that's out there and the advice of your agent, and try to get there as soon as you can. Those are some of the tips that I have. Additionally, when you first start looking, it's very frustrating because of the way our process works. Accepted offers take a while before they go under contract. We do the home inspection first. We've got that attorney process. That can take like 3 weeks. So when you first start looking, there's going to be listings that show up as though they're active, but they're really not. They have accepted offers in different stages. Expect that. Don't be upset by it. Just focus on the new ones as they come on. This is a great time of year. March, April are some of the historically the strongest months of the year. And so we have very little inventory, and I hope that sellers who have been waiting through the winter are going to come on the market. So it's a good time to start looking as new inventory comes on. It comes on all times of the year. Not everybody gets to choose, when they want to make a move. So that's sort of some of my advice. And make sure that the agent communicates with you in the way that you want to be communicated with. If it's easiest for you, because you're at work during the day, to get text messaging, make sure that the agent works that way. Because there's nothing more frustrating than, you say, I'd rather get text messages when I'm at work and they're calling you, or, that kind of thing. So make sure you talk about how we're going to communicate, and how frequently.
Okay, great.
Next
So our next question is, we have never bought a house before. However, we own property. We want to build the house. What are the options for construction loans or bridge loans, and how does that relate to mortgages?
So the credit union does offer construction loans. If you have somebody, if you're using a general contractor to build the house, we do a finance up to 90% of the value of the land plus the cost of the construction. And if you are GCing it yourself, you have to have experience in building, and we only go up to 70%.
Okay, great. Our next question is, what is the income limit for the Homebuyers Dream program in Ulster County?
If you send me an email, I will look that up for you.
Okay, great. There was another question about that. I see both of those, so I'll make sure that I share the email addresses for those. What kind of credit scores qualify you for certain loans?
So it varies, depending on the total package. So if you have a low debt to income, the credit score could be in the mid-6s. If you have a higher debt to income, your credit score has to be in the 700s. Now, SONYMA doesn't go by credit scores. They go by your credit profile. So they look to see that you haven't had any late payments in the last 18 months. They also look to see that you have at least 3 lines of credit that you've had for 18 months that you've paid on time. If you don't have traditional ones that are on your credit report, they do allow for insurance, utilities, rent, anything that you pay on a regular basis. They allow you to use that as it's called an alternate credit reference. And you do have to provide proof that you have that.
Okay, our next question is, are down payment assistance grants included in the offer as part of the down payment amount?
No, because you do not get that money until you're at the closing. So you have to have money for the closing costs. So that money that you have for the closing costs would go towards your down payment. And at the closing, you would get the down payment assistance loan funds. And the seller really doesn't need to know about that because you're getting that in the financing.
Doesn't affect them.
Right.
Okay, our next question, can you give a closing date range?
It typically takes at least 60 days right now. Sometimes longer. I mean, some towns, their building departments are taking quite a long time to get municipals back. Appraisals are taking longer. It's a very crazy market right now. Another thing, that we haven't spoken about, a lot of offers right now are being made with appraisal waivers. So if the house doesn't appraise, the person is saying they're going to buy it anyway. I'm sure Katheryn can speak a little bit about that, but it is a very crazy market right now, and there is a lot of competition out there. So you want to make the best offer possible.
If you're going to waive an appraisal contingency or a portion of it, like for example, let's say you make an offer on a house and it's $100,000. You're financing 97%, you're just putting 3% down. That would be putting down $3,000 on the $100,000. The thing is, the bank is going to be looking for the house to be worth $100,000. So if it doesn't, now you're going to have to come up with the extra cash. So it's not like you're going to pay more for the house, but you'd have to put more cash in it and less mortgage. So waiving appraisals really only works if you have the extra cash that you can do that with, because you'll have to demonstrate that you have that ability. Otherwise, what they're saying is, if it doesn't appraise, I'm not able to get my mortgage and our deal is dead. So the appraisal contingencies, are pretty common. Like I said, unless you have a good chunk of cash. There's something else that you said, Denise, I wanted to comment. Oh, the closing date. You have to have a date in the contract. It can't be an open-ended date. So there's going to have to be a date. It's an on or about date. It's not a hard date like order the moving truck. It's, it may be, if you made an offer today, being, what's today's date? March 2nd, April 2nd, you might say May 2nd, May 15th, something like that. That's on or about. Everyone knows that's the date we're working toward, but until all of these things come together, it's not a set date. Often people need to know what the date is because you've got to give notice, say to a landlord, you've got to arrange a moving truck. You would wait until you've met certain benchmarks. You would want to be in contract, have your application in, hopefully the appraisal's been done and everything's fine, and then let your landlord know that you're given your 30 days notice or whatever your situation is, letting them know that you're going to be leaving. But you do have to have some idea. It can't be open-ended, but it can be negotiated. If you say, well, we don't want, we'd like to find something now, but we really don't want to move until the end of June because we don't want to upset the kids in their school. You could make an offer and say, even though a normal time might be May, you may put on there, we'd like to close the end of June, and it would be between you and the seller to negotiate that closing date. So there's no harm in asking for what you want.
Okay, our next question is, do I need my own attorney or does the realtor have an attorney that I can use?
The real estate agent will definitely suggest or should suggest several attorneys that are local in the area. And I would say with attorneys, without, as in life, you get what you pay for. Don't shop for attorneys based on the lowest price, because you do want someone that's going to be available to you and answer your questions. It's best to stay local and use local attorneys. Sometimes I see buyers who have an attorney, say, out of the city, and they practice differently there, and it ends up, creating a lot of unnecessary drama sometimes for the borrower. If you have, let's say you are police and you get a voucher, we can recommend attorneys that take your PBA voucher as well, so you could also use a local attorney instead of an out of area one. The agents know the attorneys that work well with the buyers, so I would definitely look to your real estate agent for who are the great attorneys that will make time, sit down, explain things to us, because some are great, and some, if they're a litigator or they're in court a lot, they don't have that kind of schedule to be available to you. So ask your agent for recommendations for attorneys. But you also there's also a bank attorney that you are also paying for as the borrower, that the bank assigns. So the closing is between all three attorneys: the seller's attorney, the buyer's attorney, the bank attorney, the buyer and the seller, of course, and the title company. So all those people have to coordinate their schedules for a closing.
Okay, our next question is, how many pre-qual applications should a first timer do? How many lenders should I look at, and how does shopping around affect my credit score?
So you want to have your credit pulled by all of the lenders that you're going to get your pre-approval done by within the first 2 weeks, because it is considered one pull. After that, if you have it pulled additional times, they are additional pulls which will impact your credit score. So you don't want to go all over the place having your credit pulled like in a month or a 2 month period. You want to do it in a very short period of time. I would pick maybe 3 at the most, because I wouldn't want,
At the most.
Right, at the most, to pull your credit. I mean, really, any lender, if you have what your credit score is, they can give you an idea. If you have a credit score in the 600s, it might be a little more difficult to say, but typically if your credit score is in the 700s or higher, it's easier to give you an idea of at least what your closing costs would be.
And then, don't shop your lender based on them giving you the answer you want to hear. Shop your lender based on them, giving you solid factual information. Sometimes, with people have issues and they find a lender who doesn't check everything, and then they're like, oh, I got my pre-approval, but a good lender will have checked everything. You're not doing yourself a favor by trying to find someone to tell you the answer you want to hear. You're doing yourself a favor when you find someone who's thorough.
Yes.
Okay, our next question: in this hot market, is SONYMA a hindrance to getting your offer accepted versus a conventional loan?
Well, SONYMA is a conventional loan. It's a quasi-government loan. Because it's through the state of New York and the state of New York backs it, but it's a conventional appraisal. So to a seller, it is a conventional loan. Some realtors don't understand the SONYMA loan and have never really done it, so they do steer their sellers away from it. And if you can qualify for a conventional loan over a SONYMA loan, and that's the only way you can get your offer accepted, then that's what I would do. But right now, the SONYMA interest rate, if you qualify for their Achieving the Dream rate, that's 2.625, where a conventional 30-year interest rate is 3.25. So there is a
better interest rate. That's great.
Right. So there is a benefit if you do qualify for a SONYMA loan.
I think the issue with the SONYMA being a concern dates back a long time ago. I mean, I remember very early on, they would take longer to process. I see no issue with them at all. I think if you have to make sure that the agent that you're working with can also express, what SONYMA is if there are any questions. But I personally would never consider it being a negative.
Okay, another question. Understanding it's best to bank local for mortgages, does MHV provide mortgages for out-of-state purchases?
We do not.
Okay. What is the income limit for the loans offered on the slides?
If you send me an email, I will respond to the income limits for you. It is based on the county and the number of people in your household. So if you could provide that to me, I can give you the information.
Okay, great.
The income limit's higher if there's more people in your household.
Yep.
So.
Okay, our next question, what are the advantages of putting 20% down payment versus being more conservative?
Well, the one advantage in this market is if you put 20% down, the seller feels more confident in your offer. And also you don't pay mortgage insurance if you put 20% down. Anything else, Katheryn?
No, that hit it right on the head. You're a stronger borrower, you're borrowing less. It can be more attractive. But a lot of times in the first-time home buyer range, we don't see that kind of down payment. So it's not that it's necessarily expected.
Okay, our next question, can you explain the Homebuyer Dream program for first-time home buyers? You mentioned May 1st.
So the Homebuyer Dream, the allotment comes out, the first allotment comes out the first business day in May, and then it'll come out again in June, in July, and I believe August this year. So a certain dollar amount is given to each area, and the applications are submitted. Usually it opens up at 8 o'clock in the morning. 1 month last year, by 8:15, all of the money was gone. So you have to already, as I said, you already have to have your mortgage application in process really to be able to have a chance at getting the money.
Okay, our next question, is there an expiration on a pre-approval letter or a pre-qualification letter?
Typically they're good for 60 days, at least mine are. And I do update them, if you need them. I don't re-pull your credit if it expires within the first few months because I ask you if anything's changed. As long as you tell me no, I'm going to believe you. And that's about how it works.
Okay, would I be able to enlist the help of a cosigner if my income is too low to qualify for a loan alone?
Yes, well, with the Fannie Mae Home Ready, you can have a cosigner if you put 5% down. If you go FHA, you can also have a cosigner. And FHA requires 3.5% down.
Okay. How do I apply for the down payment assistance?
That you would apply for at the same time you apply for your SONYMA mortgage. They go together. Okay. You have to qualify for the SONYMA loan to be able to get the down payment assistance from them.
What is considered an average debt to income ratio and how is it calculated?
So your debt to income ratio cannot exceed 45%. And that is what your monthly mortgage payment is going to be, along with any other debt payments that are on your credit report. So for example, it does not include your car insurance, your utilities, your gym membership if you have one of those, daycare if you have that. It doesn't include any of those things. It only includes what's on your credit report.
These are some great questions, by the way. Really are. I don't see
I
none of
know.
the questions are popping up on mine, but that's a great question.
Okay, another question, is pre-approval different from pre-qualification?
For me, no, because I do ask for your income documents and I pull your credit. And in this market, you really have to have those items included in your document for the seller to really consider your offer.
Right. So if I see a letter as a listing agent and it says pre-qualification, I want to be sure it's a pre-approval, that they verified the credit, the debts. So you really need to talk to the lender. It's not a function of you put the calculations into a calculator and said, okay, this is how much we qualify for. I need to know that the lender has assigned the right interest rate, say based on your particular scenario, and that you're going to be able to qualify. As well as the other thing that's really important is that the lender has put in the appropriate amount of taxes. So when they qualify you for, say, the $200,000 house, they're figuring out your monthly payment, including that 1/12 of the taxes, and the insurance too, but the taxes are the big number. And if the lender doesn't put the right number in, that could mean you may not qualify for the loan. I've seen that happen. I saw that happen in the summer. I had a listing in Monroe, and it was about $400,000. And I had pre-approvals from some banks in the city for $400,000, but I believe they had like $5,000 in taxes. The taxes were $13,000. Being off by $8,000 in taxes is a huge hit to the monthly payment. Other places don't have necessarily the same kind of tax structure that we do. So making sure that the right number is in there is so important.
That happens very frequently with people who get pre-approved by somebody who is in the city, because typically their residential properties do have lower taxes than up here.
Yeah, and that hits your monthly payment a lot harder. If the taxes are $4,800 more, that's $400 a month just in taxes. So
Yeah.
making sure that that's been calculated properly into the equation is important.
Okay, our next question, how would I go about buying my parents' house and fixing it up?
So they can sell it to you and do it as a contract of sale, and they can gift you some of the equity in the house if they're selling it to you for less than what the house is worth. Or, it really, that's probably more a question for you to talk to me about, because it's a little more complicated, so I could go over it with you on the phone.
Okay, great. Our next question is just getting a pre-qual letter enough to go on, or should you go to the lender and meet and discuss in person?
Well, the pre-approval letter can be done over the phone. You don't have to meet in person, and unless that's what you want to do. And it's pretty easy to do. It takes maybe 30 minutes.
And then they would send you the documents, right? Denise?
Right.
They would
Yeah.
email you the documents that you wanted when you asked for their pay stubs
Yeah.
and things like that.
We have a secured email that they could upload them into.
Okay.
Great. Our next question, President Biden proposed a $15,000 first-time buyer credit. Is there currently a first-time home buyer credit?
Not currently.
Okay. Does the Framework Home Ownership course through Fannie Mae qualify you for the Homebuyer Dream Program grant? It looks like it is free.
So the Framework you have to take the home buyer education through Fannie Mae. That is a $75 course.
Okay. So just to clarify, the debt to income ratio is your monthly debt payments, including your proposed mortgage, compared to your monthly gross income.
Right, it would be your gross income plus your monthly mortgage payment plus the items on your credit report. That is your debt to income ratio.
Okay. If you're buying a property with an extra building lot included with 80% financing, will the extra lot be able to be subdivided? Do you need lender approval?
You would need lender approval if the mortgage encumbers that lot. So if it's one parcel, then you would need the approval after you subdivide it. If it's already a separate parcel, you do not have to include that in the appraisal and in the contract. And it could, as long as the house appraised for the value that you're buying it for without that extra lot, then the mortgage would not have to encumber it.
Okay, great. And it looks like this is our final question. In deciding if that's the lender you want to go with, is just a pre-qual letter enough to go on?
Yep, that's pretty much all the realtor needs to take you out to start looking at houses and making offers, correct, Katheryn?
Right. You have some other requirements like COVID disclosures and things like that, but in terms of financial requirements, that would be it.
Okay, and we did have another question come in requesting the Fannie Mae homeownership course link. I'm just going to take her email address and give that to you, Denise.
Okay.
And then one final question. So I need to have the entire year of taxes in order to pay the seller, or am I putting those funds in an escrow account?
So it's part of it goes to the seller and part of it goes to the escrow. The whole amount does not go to one or the other, and depending on when you close in the year, depends on how much goes to each place.
And it's not like you have to worry about figuring that out. That's the role of your attorney to do that. So they'll figure out, the proration, per day, how much goes to each party. You'll be coming with a lump sum and they will tell you how it's all gonna break out. So you'll have your mortgage money that will come from the bank. You'll have some money that's already sitting in the escrow deposit, any additional cash that you're bringing, and the attorney will say, okay, this is going here, that's going there. That's their job to lay it all out, how the money is apportioned. And you get an estimate as you get closer. We're talking some rough guidelines to get started, but the actual numbers, are going to vary based on the actual taxes and, when you close. But, it's always best to be conservative and overestimate. And if they're less, great, run off to Huffman Coos and buy a new sofa. If not, you're going to be okay. So I'd better to estimate a little bit on the high side. And it come in under.
Yes, you're much happier at the closing that way.
Absolutely.
And we do have one more question. Are fixer-uppers covered under these mortgage programs?
Only a rehab loan can you do a fixer-upper. One other thing that I did not talk about is that when you close on a mortgage, so say your closing is in May. No matter when you close in the month of May, your first payment will not be June 1st. It will be July 1st. You always skip the next month's payment. So however many days are left in the month that you close in, you pay interest on those days.
Okay, great. So I don't have any other questions coming in. If you indicated that you wanted to be contacted directly, I have received your email addresses. If you decide that you want to be contacted after the session, after you leave, just indicate that in the survey that pops up, and we'll make sure that someone gets in touch with you directly.
Okay, thank you everybody for coming tonight.
Thanks so much for being here. Good luck. Happy house hunting.
Yes, bye.